What if I told you there are ETFs that have gained over 136% this year? While the S&P 500 has been playing it safe, a select group of ETFs has been absolutely crushing the market. And we're only in October. Today, I'm breaking down the 5 highest performing ETFs you need to know about right now. We're talking returns of 136%, 135%, 120%, 134%, and 88%. The sectors driving these gains? Precious metals are on fire, and Bitcoin just crossed $125,000. By the end of this video, you'll understand exactly what's driving these massive gains and whether they belong in your portfolio. But first, hit that subscribe button because we're diving deep into verified data, not hype. Now, before we get into the details, let's talk about why October 2025 isn't just another month. This is the culmination of a perfect storm in alternative assets, and if you understand what's happening right now, you can make much more informed investment decisions. There are 3 major forces at play here. First, we have the precious metals boom. Gold is hitting all-time highs as investors flee to safe haven assets amid global uncertainty. But here's what's really interesting. Silver isn't just riding gold's coattails. Silver has a dual personality. Yes, it's a precious metal, but it's also an industrial powerhouse. Solar panel manufacturing and electric vehicle production are driving physical demand through the roof. Every solar panel needs silver, every smartphone needs silver, and as the world goes greener, that demand is only increasing. Second, we're witnessing the crypto revolution reaching new maturity. Bitcoin breaking through the $125,000 barrier isn't just a headline. It represents institutional adoption reaching new peaks. Mining companies that were struggling just a few years ago are now profitable giants with real cash flow. And third, there's the leverage effect of mining stocks. Here's the thing most people don't understand. When gold goes up 20%, mining stocks can jump 50% or more. Why? Because these are real operating companies with fixed costs. When the commodity price rises, their profit margins explode. Think of it like this. Would you rather own a gold bar sitting in a vault or own the company producing thousands of gold bars every single month? That leverage is what's driving the incredible returns we're seeing. Now, before we dive into each ETF, I need to make something crystal clear. This is educational content, not financial advice. I'm presenting verified data from official sources, but you need to do your own research and consult a financial advisor before making any investment decisions. Let's start with the king of 2025 performance, the Themes Gold Miners ETF, ticker AUMI. This fund launched in December 2023. And in less than 2 years, it's up 135.88% year-to-date. Let me say that again. 135.88%. At $81 per share with only $18.5 million in assets, AUMI is small, but it's mighty. With only 27 holdings, this fund is laser-focused on pure gold miners. The expense ratio is 0.35%, which is actually cheaper than many traditional funds you might be holding right now. Here's what makes AUMI different from other gold mining ETFs. It tracks the Selective Global Pure Gold Miners Index, and that word pure really matters. These aren't companies that dabble in gold on the side or have diversified mining operations. These are companies where gold mining is the entire business model. The top holdings tell the story. I Am Gold Corporation at 5.55%, Zhaojin Mining from China at 5.39%, Northern Star Resources from Australia at 5.11%. You're getting Canadian powerhouses, Chinese production giants, and Australian mining expertise all in one fund. The geographic allocation reflects true global gold production. 52% in Canada, 26% in Australasia, 11% in Africa, and 5% in the United Kingdom. But here's the catch you need to understand. With only $18.5 million in assets, liquidity could be an issue if you're trading large positions or if there's a sudden market panic. This is a tactical play for aggressive investors, not a core portfolio holding. The fund rebalances quarterly, which means they're actively adapting to market conditions, but that small asset base means you need to be careful with entry and exit points. This is the highest performing fund on our list, but it comes with real liquidity risks that you can't ignore. Now, if ALMI is the gold champion, then SLVP, the iShares MSCI Global Silver Miners ETF, is the silver beast. Up 136.46% year-to-date, this is actually the top performer on our list. Trading at $27.48, SLVP manages over $576 million in assets. That's 30 times larger than AUMI, and that difference matters enormously for practical investing. Here's why silver is so compelling right now, and why it's different from gold. Silver isn't just a shiny rock that people want for jewelry and investment. Silver is in everything. Every solar panel needs silver. Electronics, electric vehicles, medical equipment, water purification systems, they all require silver. As the world transitions to green energy, silver demand is skyrocketing from the industrial side, while simultaneously maintaining its status as a precious metal and store of value. That dual demand is what's driving the incredible performance. SLVP has been around since 2012, so this isn't some untested concept that launched to catch a trend. BlackRock has over a decade of experience managing this fund, and they've proven they can navigate both bull and bear markets in silver. The fund holds 42 companies spread across Mexico, Canada, and the United States. The top holding is Industrias Peñoles from Mexico at 14.25% of the portfolio. They're one of the world's largest silver producers and have been mining silver for over a century. Hecla Mining at 11.21% and Fresnillo at 10.32% round out the top three. The expense ratio is 0.39%, which is slightly higher than AUMI, but you're paying for that liquidity and institutional backing. Here's something important to consider. SLVP has more assets, a longer track record, and nearly identical returns to AUMI. For most investors, especially those without significant trading experience, that added liquidity is absolutely worth the extra 4 basis points in fees. The bid-ask spread on SLVP is tight. You can enter and exit positions without moving the market, and there's genuine institutional support if markets get choppy. Now let's talk about serious money. Ring. The iShares MSCI Global Gold Miners ETF manages $1.45 billion in assets. This isn't some boutique fund. This is where institutions, pension funds, and serious money managers allocate capital. Up 134.80% this year. Ring proves you don't need to chase tiny, risky funds to capture massive returns in the gold mining space. Trading at $65.49, Ring is the most liquid gold mining ETF on the market. BlackRock has been managing this fund since 2012, and they've perfected the formula for capturing gold mining upside while managing the inherent volatility. The fund holds 41 companies, but here's what's different. The concentration is in industry giants. Newmont Corporation makes up 14.77% of the portfolio. Agnico Eagle is 14.10%. These aren't exploration companies hoping to strike it rich. These are the bluest of blue-chip gold miners with proven reserves, established operations, and consistent production. The geographic diversification is exactly what you want in a global gold fund. Over 53% is allocated to Canadian miners, which makes sense because Canada has some of the most stable mining jurisdictions in the world. 19% is in U.S. miners, 12% in South Africa, which has some of the deepest and richest gold deposits on Earth, 5% in China, and 5% in Australia. You're getting true global exposure without the headache of trying to buy international stocks directly, dealing with foreign exchanges, or worrying about currency conversions. Think of Ring as the just right option in the Goldilocks framework. It's not too small like UMI, where liquidity might be a concern, but it's focused enough to truly capture the gold boom rather than being diluted across multiple metals or mining segments. The expense ratio is 0.39%, identical to SLVP, and the dividend yield is 0.71% paid semi-annually in June and December. If you only pick one gold mining ETF from this entire video, RING is probably your answer. It balances performance, liquidity, management quality, and risk better than any other option in the space. Now remember how I said AUMI was young, launching in December 2023? Well, AGMI, the Theme Silver Miners ETF, only launched in May 2024. In just over a year and a half, it's up 120.44%. That's not a typo. This is the youngest fund on our list and also the most aggressive silver play available to investors right now. With only $3.79 million in assets, AGMI is the smallest fund we're covering today. At $54.03 per share with 38 holdings and a 0.35% expense ratio matching AUMI's low cost, this fund is designed for one thing: maximum silver mining exposure. It tracks the STOXX Global Silver Miners Index and rebalances quarterly, which means the management team is actively adapting to the fast-moving silver market rather than being locked into annual rebalancing like some competitors. When you look at the top 10 holdings, you'll see familiar names from SLVP, Newmont Corporation at 9.83%, Fresnillo at 9.47%, Franco-Nevada at 9.10%, and First Majestic Silver at 6.11%. But here's where AGMI differentiates itself. It goes deeper into smaller miners. Companies like Discovery Silver at 4.43% and Endeavor Silver at 5.10% give you exposure to growth stories and exploration upside that the larger funds might not capture as effectively. Here's the real talk you need to hear. $3.79 million in assets means this fund could really struggle during market panic. Wide bid-ask spreads are a real possibility. Tracking errors could emerge if redemptions happen quickly. There's limited institutional support because big money managers simply can't allocate meaningful capital to a fund this size. This is for experienced investors who understand they're taking on extra risk for potentially extra reward. The performance has been spectacular, but you need to go in with your eyes wide open about the liquidity challenges. Now for something completely different. Every fund we've discussed so far has been about metals you can physically touch. STCE, the Schwab Crypto Thematic ETF, is about the digital revolution, and it's up 88% this year with a staggering 149% return over the past 12 months. October 2025 has been remarkable for crypto. Bitcoin crossing $125,000 isn't just a milestone. It represents genuine institutional adoption and mainstream acceptance. But here's the genius of STCE. You're not buying Bitcoin directly. You're buying the companies that make Bitcoin and the entire crypto ecosystem possible. With $282.7 million in assets at $85.67 per share, STCE holds 43 companies across the crypto value chain. The sector allocation tells the real story. This is 64% information technology and 31% financials. This is fundamentally a tech play with financial services exposure, not a commodity bet. The top holdings are companies like Cipher Mining at 8.60%, Iron Limited at 6.79%, and Hive Digital Technologies at 6.29%. These are crypto mining companies, but they're also infrastructure providers for the blockchain revolution. They're running massive data centers, developing specialized hardware, and providing the computational backbone for decentralized finance. Here's an analogy that makes this crystal clear. In the 1800s, California gold rush, some miners struck it rich. But you know who really got wealthy? The people selling picks, shovels, jeans, and building the infrastructure. Levi Strauss made a fortune selling pants to miners. That's what STCE represents. You're investing in the infrastructure of the crypto revolution. The fund has an extremely low 0.30% expense ratio, which is remarkable for a thematic ETF in a rapidly evolving space. The geographic allocation is heavily US-focused at 80.65%, with 13.68% in Canada and 3.56% in Japan, while the broader digital assets category averaged just 14.79% returns this year. STCE crushed it with 88%. That outperformance shows you're getting true alpha from active selection of the best-positioned companies in the space, not just passive exposure to anything with crypto in its name. But let's talk about risk, because this is crucial. Crypto is volatile. We all know that. Regulatory uncertainty is very real. Governments around the world are still figuring out how to regulate this space. Some companies in this fund could face sudden regulatory changes that impact their business models overnight. The SEC, international regulators, and even local authorities are all navigating uncharted territory. This is the highest risk, highest reward fund on our list. The potential for continued massive gains exists, but so does the potential for significant drawdowns if sentiment shifts or regulations tighten unexpectedly. So which one should you choose? Let me give you a practical framework for thinking about this decision. If you're a conservative investor who wants exposure to this trend but can't stomach high volatility or liquidity concerns, go with Ring or SLVP. Both have over $500 million in assets, established track record since 2012, institutional backing from BlackRock, and proven management through multiple market cycles. You're giving up a small amount of potential upside, but you're getting safety, liquidity, and peace of mind. If you're a moderate investor willing to accept some additional risk for higher potential returns, consider AOMI for gold exposure and pair it with SLVP for silver. You get higher returns than the institutional options, reasonable liquidity that won't cause major problems for most individual investors, and you're still in funds with professional management and clear strategies. This is the sweet spot for many experienced investors who understand precious metals but don't want to be in the most aggressive vehicles. For aggressive investors, AGMI gives you maximum silver mining leverage. The small asset base and newer launch date mean you're taking on meaningful liquidity risk, but the potential for outperformance is real if the silver bull market continues. Pair it with STCE for crypto exposure, and you've got a truly aggressive tactical allocation that could deliver outsized returns or significant volatility depending on how 2025 unfolds. Here's a critical point about portfolio construction. These are tactical allocations, not core holdings. I would never recommend putting more than 5 to 10% of your total portfolio into these types of thematic, high volatility ETFs. They're correlated with each other, especially the precious metals funds, so don't buy all 5 thinking you're achieving diversification. If you want true diversification within this space, consider pairing one precious metals ETF with STCE. That gives you hard asset exposure and digital asset exposure, which genuinely behave differently in various market conditions. What's hot in October 2025 might cool off significantly in November or December. Market conditions change, commodity prices fluctuate, and regulatory environments evolve. You need to understand your own risk tolerance, investment timeline, and financial situation before allocating any money to these investments. But now you understand what's driving these massive gains. You have verified data from official sources. You know the expense ratios, the asset bases, the top holdings, and the strategic differences between each fund. You understand the risks and the potential rewards. You're equipped to make an informed decision or to have an intelligent conversation with your financial advisor about whether any of these funds make sense for your specific situation. If this breakdown helped you cut through the noise and understand these investment opportunities, smash that like button and subscribe for more data-driven investment analysis. Drop a comment below. Which of these 5 ETFs would you consider adding to your portfolio? Or do you think the precious metals boom is already over and it's too late to get in? I read every comment and I want to hear your perspective. And if you want to see how these ETFs perform through the end of 2025, hit that notification bell because I'll be tracking these exact 5 funds every single month with updated performance data and analysis. Thanks for watching, and I'll see you in the next video.